Let's start with the jobs numbers. There was a lot of data this week. Let's start with the jobs numbers. What did they tell you? What did they tell us about where we are in the economy?
It was a really big week, and that was a very powerful segment from Larry Summers and difficult to follow. The jobs report was one of the indicators that we got during the week that the economy is slowing, but it's still a healthy economy. Employment is still strong. The employment market is still tight, but the Fed should get a little bit of help from a slowing economy. That said, I very much agree with what Larry said regarding the Fed and many other things, that the Fed shouldn't take this slowing for granted as mean that inflation is going to keep working its way down. They need to keep an eye on this risk because the risk of inflation staying above their 2% target is still very much with us. But the good news this week was relief in the bond market. We saw yields across the curve come down, especially toward the end of the week, and that rally in fixed income, rally in equity markets upon that lower yield environment. What we saw is that May followed a tough April. April showers brought in some May flowers.
It's early in the month. We'll see.
It's early in the month. We'll see.
So talk to us about growth. You said it's a slowing economy. We heard Chair Jay Powell this week say he doesn't see stagflation. He doesn't see the stag. He doesn't see the inflation. Right. Are you at all concerned about really slowing growth to such a degree that you should be worried about the economy?
I'm not worried about the economy yet. I would have to really see the jobs growth number fall below 100,000 before I really started getting worried about jobs. And the economy is very resilient because it's a service-oriented economy. And we already went through a good amount of inventory liquidation and correction already, and that often is a cause of at least small recession. So a lot of risks, there are always tail risks. But this economy, I think, has a real safe distance away from a recession. And because of that, I think the Fed should stay focused on making sure inflation keeps on working its way down to target. But things have slowed down. I would say U.S. GDP growth is still in probably a little bit above a 2% trend, and that's healthy. But inflation relative to that growth rate is still too high. Earnings this season were another encouraging part of the week. Really good news out of most tech companies. Not bad news, but not as good as hoped out of the non-tech companies.
Well, talk about that specifically. We've had such a bifurcation in the S&P 500 and the stock market generally on that. What about earnings for the top guys, the big tech, as opposed to the rest? How do they compare?
Well, the biggest, or what I call the grade 8, which would cut across big cap tech and communication stocks, and a couple of consumer discretionary companies. These grade 8 companies continue to lead the market upward, and their earnings growth will be over 50% on a year-on-year basis, whereas the other 492 companies of the S&P, only about 2% earnings growth year-on-year. So it's a bifurcated market. We're hearing a bunch of consumer-oriented companies, staples, retailers, fast food companies saying they're seeing a slowdown. Nothing falling off a cliff, but slow down, and their customers more price conscious.
What does that all tell the Fed? You heard Larry say there, it's certainly a lot less cuts we're expecting than we did at the beginning of the year. Do you expect any this year?
Well, like I said, this was a week where, particularly the jobs report, but some other service-ism, manufacturing-ism type of reports that said the economy is still slow on manufacturing and slowing on the service side. There's hopes for a September cut. I don't think that'd be prudent. I think it's better they wait until after the election, December, and just do some real slow cutting next year.
So give us some investment advice here. Help us make some money. What are you particularly interested in right now? I mean, it sounds like the big 8 sounds still pretty attractive.
That's where the growth is, but that's where the extremely demanding valuations are. What I'm doing is that, one, I do think the equity market I think it's going to be stormy this summer before the elections. So keep some dry powder. I like financials, and they've been doing well. And part of that's because interest rates are still quite high. There's risk they go higher, longer term yields. Banks make good money when employment's strong, the economy's fine, and interest rates are high. Another sector that I like, despite interest rates being high, utilities. We see very effectively full capacity utilization.
So explain how that works. Why are utilities particularly attractive right now to you?
It's finally, after many, many years of no growth and shrinking demand for electricity in the United States, so many things have converged, whether it be the data centers, where there's rapid growth, electric vehicles, cryptocurrency mining. Finally, we have in this digital economy, which is the strong part of the economy, we've got a lot of electricity demand. You got to feed AI. AI is fed with electricity.
One last thought, if you would, on the consumer. It's driven so much. Is it going to hold up?
Yes, the consumer is going to hold up, but first there's been a splurge on consumer spending, kind of the reopening of the economy, but the higher interest rates are definitely affecting a certain part of the economy, and we're seeing continued slowness in durable goods consumption, cars. The financing costs are biting into people's willingness to buy now, but the service side will hold up, the economy will hold up.